futurist, I like to think that it is my job to look ahead. So this year, I would like to cover the emerging blockchain trends that would shape the digital world in the next 12 months. What technologies are gaining the most traction? What are the biggest trends for business leaders to be prepared for? This article explores these trends, their impact, and their future implications. Trend number 1. Blockchain advancement increases with enterprise adoption. Workers of companies that carry out activities that involve digital technologies to build BlackRock's recent introduction of a Bitcoin spot ETF has ignited renewed institutional interest in cryptocurrencies and sparked discussions about the implications of investments in the broader financial ecosystem. BlackRock's decision to hold real BTC over futures contracts in its ETF has encouraged other major players like WisdomTree and Invesco to review applications for their own Bitcoin spot ETFs. EDX Markets, a cryptocurrency exchange backed by Charles Schwab, Fidelity Digital Assets, and Citadel Securities, also launched its platform and successfully secured a round of funding. To get around potential regulatory hurdles, EDX operates as a non-custodial exchange, refraining from holding customer crypto assets during transactions. Additionally, the SEC has not considered any of the initial cryptocurrencies offered on EDX Markets as securities. Industry insiders view the institutional acceptance of cryptocurrencies as a critical evolution. It indicates confidence in Bitcoin's potential as a mainstream instrument in traditional finance and could improve market stability by curbing volatility. Institutional adoption can democratize access to cryptocurrency investments and shape the future of digital assets. While regulatory and security concerns persist, the potential for greater market stability and broader access to cryptocurrencies underscores the critical role institutional players play in the progression of digital assets. Trend number 2. Wall Street embraces asset tokenization and digital transactions, transforming the financial landscape. Prominent financial institutions such as JP Morgan Chase, Goldman Sachs, BlackRock, and Fidelity are recognizing the transformative potential of blockchain technology. By exploring the reaches of asset tokenization and digital transactions, these institutions are pioneering notable developments in the financial domain. A clear regulatory framework and partnerships with trustworthy financial entities are their optimal tools to leverage blockchain expertise to amplify transactional efficiency. Blockchain technology is at the forefront of enabling the tokenization of real-world assets via smart contracts, which has the power to make transactions more efficient and secure. According to Citigroup analysts, tokenization could potentially encompass private sector securities, funds, central bank digital currencies, and stablecoins, reaching a staggering $10 trillion by 2030. Notwithstanding the challenges, such as differing views on tokenization and the choice between public and private blockchains, Wall Street clients are showing increasing involvement, signifying a sentiment shift. JP Morgan's Onyx Digital Assets platform, for instance, facilitates the creation of tokenized representations of traditional assets, enhancing efficiency while cutting costs. JP Morgan Chase's enlargement of its blockchain-based payments platform for Euro transactions and its venture into asset tokenization epitomizes the industry's untapped potential. Citigroup foresees the tokenization of private sector securities and funds to amount to $5 trillion by 2030, incorporating diverse assets like corporate debt and real estate. An additional $5 trillion could circulate into burgeoning digital currencies. The merging of traditional financial institutions with blockchain technology is molding a new financial landscape, unlocking fresh market possibilities and boosting transaction efficiency. Trend number 3. The rising power of decentralized finance, DeFi, and its impact on modern industries. As DeFi, decentralized finance, expands its influence in the fintech scene, it's also enabling the birth of new facets like GameFi, SocialFi, and InsurTech. The majority of these platforms owe their existence to Ethereum's powerful smart contract abilities. DeFi aims to replace middlemen with quicker, superior, and more cost-effective systems, though issues tied to liquidity protocols and user vulnerabilities persist. The value of DeFi is particularly clear for SMEs, small and medium enterprises, and emerging markets. DeFi's programmability brings to life tailored financial tools and smart contracts that streamline operations and cut costs. The trust in financial transactions stems from the blockchain-backed transparency and unchangeability of DeFi. The spotlight here is on the burgeoning DeFi-based technologies that promise job creation and business expansion. They include Bizify, blockchain-based business management tools and dApps; FanFi, fan-centric fintechs, enhancing fan-based management and revenue generation; GameFi, tools to handle finances within blockchain games, ensuring transparency and preventing fraud; IndFi, industrial applications that enhance efficiency by removing intermediaries; MediaFi, decentralized technologies for multimedia production, improving financial management; RegFi, trust and transparency in regulatory processes using smart contracts and decentralized governance; SciFi, financial backing for researchers, guaranteeing transparency and equitable funding; SocialFi, decentralized social media platforms with user verification, proof of ownership mechanisms, and blockchain payment systems. Each offers distinct advantages and propels progress within their respective sectors. For instance, while GameFi develops a thriving secondary market and boosts player engagement, IndFi refines industrial processes. However, it's critical to address environmental concerns related to blockchain gaming platforms' energy usage. These DeFi-driven technologies have the potential to redefine various sectors, promoting efficiency, transparency, and innovation. Trend number 4. Central bank digital currencies as a monetary anchor. With the rise of digital payments, central banks are swiftly recognizing the need to create trustworthy digital assets for economic stability. Enter central bank digital currencies, CBDCs, the answer to a risk-free digital standard, serving as a monetary anchor amidst the evolving financial landscape. The advent of digital money questions the effectiveness of physical cash as a monetary anchor. CBDCs preserve the principle of monetary singleness and shield monetary sovereignty by enabling conversion between various digital currencies. The Digital Euro project, currently in its investigative phase, aims to provide a comprehensive response to this challenge. The surge in digital finance tokenization is pushing central banks to re-evaluate their tech infrastructure for central bank money issuance in wholesale transactions. This might involve linking market distributed ledger technology, DLT, platforms to central bank infrastructures, or creating a new DLT-based wholesale settlement service combined with DLT-based central bank money. Central banks understand the need to involve the market in their research. Partnering with market players ensures developments align with market dynamics and needs, fostering the seamless integration of digital currencies into the financial systems. The shift to digital assets signifies a complex path towards financial innovation, with central banks playing a pivotal role in directing this transformation and maintaining trust in digital money. Trend number 5. Navigating the new normal with increasing blockchain regulation. Cryptocurrencies, while lauded as decentralized alternatives for financial services, often fail to meet expectations. Issues with the underlying blockchain technology, like sluggishness, high energy consumption, and scalability issues, render day-to-day transactions unfeasible. As a result, the crypto ecosystem has leaned towards more centralized forms, prioritizing speculation and rapid profits, ironically mirroring the flaws blockchain sought to rectify. Recent events have exposed the frailty of the crypto ecosystem, causing confidence in cryptocurrencies to plummet rapidly. Rather than fostering a sustainable crypto future, integration into the financial sector amplifies contradictions and vulnerabilities, inducing greater instability and centralization. It's critical for the public sector to respond with a comprehensive regulatory framework addressing the social and environmental risks tied to cryptocurrencies, such as speculative use of unsupported assets. State backing of cryptos should be avoided to prevent socialization of crypto risks. The emphasis should be on crafting dependable digital settlement assets like central bank digital currencies. Decisive action from the public sector could encourage the crypto ecosystem and blockchain technology to reassess their objectives and deliver genuine economic value within the digital finance landscape.